Hello, everyone. Today on the final bar, I'm joined by Todd Sohn from Strategas Securities in New York. He does a great job always of trying to put the current market movements into proper context. I've talked about this week being sort of a digestion week, and I think we're getting more of the same here today. The last couple of days, really after the long Labor Day weekend holiday, sort of have this fluctuating market, some up moves, some down moves. Overall, the S&P netting to the negative side with mega caps underperforming just a little bit. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of stock charts. We focus on data visualization techniques, the technical analysis toolkit to try to quantify price, breadth, sentiment, trend, momentum, all of those great pieces of information that help us understand what investors are doing and how they're voting with their capital. And we've talked about this sort of digestion phase that I would argue this week is certainly, appearing to be, which is basically, you imagine the last couple weeks, last couple months even, or the big meal, and then you need that time afterwards to sort of relax and digest that big meal. And that's sort of what we've seen overall this week has netted out to kind of a flat week. We're sort of chopping around. We have leadership rotation. We have sectors that are up and down on given moments. Today's a little more of a rotation back to things like financials and energy. Really, only a couple of the S&P sectors higher, and things like real estate and healthcare really moving to the downside. But overall, the S&P is sort of still holding steady to where it's been. We're going to look at a chart of the S&P and many, many more here momentarily in our market recap. Wanted to let you know about their upcoming schedule. Great guest today with Todd Sohn from Strategas. Excited to talk to him here momentarily, get his take on the current market environment. Next week on Tuesday the 14th, we have Louis Llanes from WealthNet Investments in Colorado. On Wednesday the 15th, Alessio Rutigliano. Alessio is a Wyckoff method expert coming to us from San Francisco. We'll talk particularly about cryptocurrencies and what the methodology is suggesting there. Next Thursday the 16th, we have Frank Capillari from Instinet in New York. And then next week on the 21st, we have Tony Zhang from Options Play coming back, giving us an options idea. Also, a couple quick events to point out to you. We have the TSAA annual conference coming up here on September 18th. The TSAA is the oldest technical analysis oriented organization in the United States, predating just by a little bit the CMT Association, where myself and many others have been involved. The TSA is based in San Francisco. They're doing their annual conference on September 18th, which StockCharts is very happy to support and sponsor. Great presenters like Chris Kimball, Arusha Paris from IBD, Alessio Rutigliano, as I mentioned on our show next week, Brett Steenbarger talking about investor psychology, trading psychology, Ari Wald, many others. Go to tsaasf.org for more information there. Also, just to let you know, my next webcast will be coming up next Tuesday, the 14th at 1 o'clock Eastern, called How to Avoid Confirmation Bias. I have found that this to be the most sneaky behavioral bias of them all. It creeps up in all parts of your process, and not just if you're just getting started, but seasoned investors that have been doing this for decades still fall victim to this. And this is basically where you develop your thesis and then start to gather evidence just to confirm what you'd already decided. We'll talk about how it comes up, how to minimize its impact, and how to develop some better routines. Sign up for that event at marketmisbehavior.com/confirmation bias. Let's continue on with today's market recap. So as I mentioned, digestion phase continues with the S&P and major indexes netting out to a negative move today, not by much. The S&P down just under 0.5%, closing just about 44.93. The Nasdaq down just a little bit less than that, about 0.25% or so. Mid caps and small caps a little bit less as well. So the S&P 500 sort of led the way down, and the VIX is back up nearing the 19 level. Other asset classes very quickly. Interest rates actually coming off. Yesterday, 10-year yields came down to around 133, continuing lower, dipping below 130 earlier today, settling in right around that level. And the TLT, which we often use for bond prices, up over 1% today. Commodities overall mixed, although gold and precious metals, which have certainly been struggling. The chart of silver and gold we've talked about in the last week at times about this overall downtrend and this the recent push to the upside, sort of coming off as both of those have retraced a little bit, both moving a little bit higher, a little less than 0.5% up today. Cryptocurrencies also mixed with Ethereum, essentially a flat day. Bitcoin very much a flat day, but sort of gapped higher before the equity trading session began around 46,600, just below there. Let's look at the S&P 500 chart and just remind you again, I don't think the picture changes much day to day, and that's on purpose. I think the goal as a long-term investor is think about days like today and how they fit into the context of the longer-term trends. If you want to understand the market trajectory, focus on the long-term trends, then start to think shorter term and think about those fluctuations and what they may mean. As we've talked about in recent days and really weeks and recent months, the uptrend is firmly in place, right? Charles Dow calls this an uptrend because we keep making higher highs and higher lows. And in some ways, the trend following discipline that we talk about on the show often is simplicity in itself. It is potentially the most simple investment process you could ever use, which is analyzing charts and following trends. I think your goal is to, number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends are exhausted. And I will tell you for those first two, the trend is firmly to the upside so far. We continue to make higher highs and higher lows. We're just coming off of a new all-time high in the S&P last week as we touched 4550. We've pulled back over the last couple of days. Again, I call this a digestion phase. We had the big meal. You have a bit of a pullback. Average moves like this have been in the 2 to 4% range. You've had a couple that are a little more significant than that, but a 4% pullback would take us right around to the 50-day moving average around 4420 currently. I would argue if I'm looking at a chart of the S&P, that August swing low, which is around 4360, as long as we remain above that, I think you could still call this an uptrend of higher highs and higher lows. Once we violate that, you would have to start reconsidering the overall market structure and question whether the uptrend is firmly in place. The 50-day moving average, though, I can tell you what concerns me about that is so many people, myself included, have clearly honed in on the fact that the 50-day moving average has served as support the entire year of 2021. And that's great because it continues to work. The challenge is the first time it doesn't work. When you do violate the 50-day, I think you will hear a lot of people get a lot more negative very quickly when we get the sense that the market is different, that something is changing, and that there's what I'd call a change of character on the chart. So I would look out for that currently around 4421, as I mentioned. Let's continue on just talking about the market movements today. So you had plenty of things jumping higher today. Airlines caught my eye early on, sort of moving to the upside. We'll look at those charts here momentarily. On a sector basis, it was only a couple S&P sectors that finished the day in the positive. Financials and energy both up less than 0.25%. Materials were essentially flat. On the downside, you had real estate and you had healthcare and the consumer staples, some fairly defensive sectors there at the bottom with real estate, consumer staples, and utilities. For sure, healthcare kind of a mixed sector because you have a lot of different themes that are sort of played out in that particular sector there. That's how the sectors played out. Let's look at the chart of let's see, American Airlines would be a good place to start. So all the airlines sort of bumping a little bit higher today. And while on the surface that seems like a really good thing, again, I'd always encourage you to take a step back and just look at the trajectory. So a big move higher, over 5%, quite a nice move. That certainly seems on the surface to be fairly constructive, and I get that. The challenge I have with the chart of most of the airlines is they just haven't been good longer term charts. These are charts overall that have been rotating from a period of outperformance in the first quarter, really through the end of the first quarter of this year, to a period of consistent underperformance. If you look at the last couple months, the price has been choppy to down. The relative strength has been very negative. So overall, you just haven't really been paid to own airlines yet. Now, days like today strung together, if you have more of these days and you start to put in higher lows like we've potentially put in, and I think, yesterday's low, the low from this week around 19 might be a really interesting level to pay attention to see if we're able to hold that. That's the beginning of a chart that's starting to rotate more in a positive direction. But I would always be looking for some sort of follow through. A big move up like this is encouraging. Let's see if we continue to the upside the rest of this week into next week. Same with charts like Delta Airlines and others. Again, if you look at today's trading, encouraging, but again, on a long-term trend basis, I'd be a little concerned about the overall trajectory there. There are plenty of charts that are actually starting to rotate higher. There are plenty of charts that are actually starting to rotate lower. And I do a very simplistic pencil and paper routine that I've done for years and years, which is literally going through a bunch of charts, screening for new highs and new lows, and just sketching out their patterns on a piece of paper and just writing down which tickers look like others. And it's a great way to sort of focus in on which stocks are starting to rotate higher or lower. Disney is a really interesting chart to pay attention to. We might finish here. Disney is one of those stocks that did incredibly well. If you look at 2020 into 2021, this is maybe an ideal example of a company that really rotated in a really good way to streaming media. This is a company that was very, hardwired to, people going to parks and being there in person with a lot of other people, which started to not be practical last year. But all of a sudden, they made this huge, pitch or rotation to Disney Plus, the streaming platform, grows fairly successfully, surprises a lot of people at the pace of doing so, and the chart certainly following through to the upside. In March, though, that started to change, and you can see there's this period of underperformance where we potentially are wrapping up now, where the stock came down from touching $200 a share down to around 170, 165. You can see May, June, July, August, we've tested that 170 level a number of times, and now we're back to the upper end. And I think this could be a really interesting rotation, or an example of a rotation from a distribution phase to a consolidation phase to an accumulation phase. Just a very simple rotation from more sellers than buyers, anecdotally speaking, an equilibrium of buyers and sellers, and then all of a sudden buying power starting to outweigh selling pressure. And I think that's an interesting chart to see if it can regain 185 and stay there. We need to take a quick break. We'll be back with my guest, Todd Sohn. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we try to make sense of these markets together in uncertain times using the discipline of technical analysis. I would argue if you know nothing else, look at the chart of any ticker, any stock, any ETF, go from there. That'll tell you a lot of what you need to know about the overall characteristics of that stock and its positioning. A couple quick comments before we get to today's guest, Todd Sohn. Number one, we'd love to hear from you, particularly questions as you are analyzing your own charts. As you're using stock charts, questions that come up on our platform, technical analysis, technical indicators, behavioral biases, market history, whatever it is, we get a lot of questions in a lot of different topics, and we'll do our best to answer them on the air. You can email us your questions at thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our Stock Charts channel. We'd love to hear from you. Hope to answer one of your questions in our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. You can use your email address, set up a free account, start watching all of our great content from our website, also from your mobile devices. Great guests like Todd Sohn and many others. Special events like The Pitch, Charting the Second Half, our year-in review coming up in December, all of that and more on demand. Go to StockChartsTV.com or just search on your mobile device on any of the app stores for Stock Charts TV on demand. I want to welcome on today's guest, Todd Sohn. Todd's a technical analyst at Strategas Securities, coming to us from the New York area. He's been on the show before, always does such a great job of trying to put the market into proper context. I followed Todd and his work for many years. And Todd, welcome back today.
Hey, Dave, nice to see you as always, and thanks for having me.
Good to see you too. And you're starting us thinking about sort of this overall dynamic. There's been a lot of focus on the FANG stocks and the dominance of this mega cap trade. Start us here looking at the equal weighted S&P. What are you seeing?
Yeah, so listen, there's no doubt that trends across the U.S. equity landscape, they're up and to the right. They are strong. We don't want to fight that, right? The equal S&P here on the top panel just broke out a few weeks ago. You're within a day or so of a fresh high. That's great. But what's interesting to us is what's going on within the leadership backdrop. And on the bottom panel, we're showing the equally weighted S&P. So the average stock, right, relative to the S&P top 50 index. So this is an index of just the 50 largest S&P names, from Apple down to some of those names in the $100 billion market cap. And there's been a significant rotation back to that mega cap spectrum. And so this is not the same environment we were used to from the first and second quarters of last year and this year, right? The opportunity set is getting more selective, and folks are being driven towards the Apples and Amazons as opposed to, say, some of those industrials and smaller financial names. And while it's not the end all for the markets, it becomes a more frustrating tape. At least that's what we believe going forward.
It's always frustrating to have the market call right, but not actually get paid for it by being in the right names. I think we've all probably dealt with that at some point in our careers or in our investing experience. Your second chart, Todd, is looking at the S&P and then looking at new highs. Tell us about this one.
Right. And so this goes in hand with the leadership backdrop shifting towards mega caps. Coming off of the lows last year in March, you saw surges in the new high data, right? That signaled to us this was a major momentum market, right? And it was robust all the way through about June of this year. And as the S&P 500's gone on to make new highs with each week here, the new high data based on 3-month highs has dried up. And so that tells us it's large cap names pushing the index higher, reflective of more selectivity, and that you should be paring down. It's not the buy it all market anymore. Now this can change, and we want to see that change. But as long as the new high data isn't as robust, the market can be on borrowed time here. It can persist like it did in the '90s, but you have to keep your guard up at the very least.
So it's interesting as we have this situation. We're in the seasonally weakest month of the year, seasonally weakest part of the year for sure, right? September into October. And we've had, sort of an anemic number of new highs, as you can see from your chart, the equal weighted S&P underperforming. Where do you look opportunistically between now and year end? Is it sticking with some of those FANG stocks, the mega cap names that have just done so well recently? Or is this an opportunity to get back into some of the cyclicals and others that have been struggling in a short-term basis?
Yeah, I think it's a barbell there. I think you can
Hmm.
stick with the apples, right? Those are great trends. I don't want to count out the cyclical names yet. For example, a lot of these big banks, they're still in really great trends. They've just been sidestepping their way around the last few months. So I don't want to say that they're big tops or anything, that there will be an opportunity to add to those, perhaps on one more flush lower. And then if you're really worried about the direction of the market, right, as you mentioned, weak seasonality, I think healthcare is worth a look in terms of defensive areas. When you think big picture on healthcare, there are a lot of charts that have gone nowhere for 5 to 6 years. Pfizer in the last 20, right? That's one of the bigger bases we can find. A name like Regeneron. Yeah, I do think healthcare has some interesting longer term big bases there. So that's part of that barbell of staying within tech and cyclicality and a little defensive positioning. I know it's a lot to handle, but I do think if you're getting more selective, you focus on those attractive charts just starting to emerge from big bases.
Now, when you're thinking, Todd, if I can ask him one more question. So when you're thinking about the S&P, you've hit on, I think, what we've been talking about for a while, which is this resilient market, right? Continues to make new highs, new low, or higher lows, and just continues to be an uptrend. What would you see from the broader market or from leadership rotation, or what would you see that would tell you conditions are starting to change and you really need to start getting defensive? Is there a particular signal or indicator, breadth reading that would tell you this is now a market to start to worry about?
I want to watch the equal weight discretionary versus staples ratio. I don't love cap weight because it's Amazon and Tesla versus Walmart. The equal weight discretionary, you have the hotels in there, right? The cruise lines, the more reopen and cyclical type of opportunities. That ratio has been sideways. That's okay for now. But if you start to see that dip lower, that to us is a major flag that risk appetite is declining and perhaps economic activity is also starting to decline too. So I would point everyone in the direction of that. A very, very important chart for the end of the year.
It's a great take. Todd, listen, thanks for coming on. I wish we could spend so much more time talking. You have such great information and experience in the markets. Really appreciate it. Be well, stay safe. We'll talk to you again soon.
Likewise. Thanks, Dave. Appreciate it.
That's Todd Sohn. Todd's a technical analyst at Strategas Securities in New York. And again, from my days on the institutional buy side, I will tell you, having the opportunity to talk with guys like Todd and Chris Verone at Strategas and others that really know the markets and know their stuff, it was just a real pleasure. So I'm super excited we could share that with you today. Overall, I love that thought about thinking about consumer discretionary versus staples, that offense versus defense look. We have a chart in our Mindful Investor Live chart list, which we've talked to you about before on the show about, thinking about that general rotation. And he made a really good point, which was thinking about the equal weighted. It takes the overweight on things like Amazon, Tesla, Home Depot. They're huge weightings in the XLY, consumer discretionary. So an equal weighted version gives you a little better read on rotation there. Let's continue on with today's show. Our next segment is called Getting Sentimental. We love to do, usually on a Thursday, is take a look at how the picture has changed on a sentiment basis. We talked about our big picture approach to macro investing from a technical perspective has three parts: price number one, breadth number two, sentiment number three, and thinking about them in that priority order does not tell me that sentiment is not important. I think it very much is. But for me, price is most important because I think that tells you a lot of what you need to know. If I knew nothing else, the price of the S&P would tell me a good deal about the market conditions. Breadth helps you understand that. And I think some of the charts that Todd showed us here moments ago are great examples of that, the value of market breadth and looking for what's actually leading the market higher or lower. And then finally, we have sentiment, which are some more anecdotal pieces of evidence helping you understand positioning data, survey data, and just what people are saying and thinking and how they're positioning themselves based on their interpretations of the market environment. We'll go very quickly through a couple of these. One of my guests recently, I think this was Bob Lang last week from Explosive Options last Wednesday, if I remember right, did a great job talking about the VIX. And his comment was the VIX over 20 has really been the floor here in June, July, and August. On the last series of pullbacks, we've had, the VIX go just above 20. That's pretty much at or near the short-term bottom. And again, I have no problem with that sort of short-term pattern. My question would be, of course, do we see another addition? Do we see another continuation of that pattern? The VIX going below 20, we pull back a little bit more. Is that another Bible dip? And the reason why I think that's important to watch on this chart is because what if it's not, right? What if the VIX spikes above 22 and goes to the highest level it's been since May? What if the S&P pulls back a little bit but does not stop when the VIX gets just above 20? Is this something different that would tell us conditions have changed than they've been over the last couple months? That's why I think that's an important chart to watch. It's currently just below 19, and I'm say as the market continues to pull back, very much an important chart to watch to see if the VIX gets above 20 as it has in previous pullbacks. The AAII survey data has actually narrowed a little bit. So you had sort of a rare occurrence where you had less bears and less bulls. So usually you get sort of this rotation and one decreases while the other increases or vice versa. This week you actually had them both narrowing. And the way that's possible is because there's a third bucket neutral, which we rarely show. So what this tells you, there's a bit of indecision in this last survey where some people are taking their vote from bullish and going to neutral, bearish going to neutral, and it's netting out to just less less confidence or less, decision making, I guess, overall, or less force behind those calls. The spread between bulls and bears remaining relatively consistent. And I would note we actually had a question on this, which I'll save for tomorrow's mailbag. But it's worth noting that from April to June to August, we've had less bulls in this survey as the S&P has gone to new highs in each of those months. The name exposure index actually came down over the last week. This is a survey of active money managers and how they're actually positioned on equities, net long or leveraged long, naked equities, net short or leveraged short are their answers that they can do. It's come down. It was around 90% last week. It's down to around 85%. So still, relatively average, to be honest with you, for a bull market phase. This is not euphoric, which I would say above 100%. It's not super light on equities as it was back here in May, which is an indication that we might have pulled back just enough. Overall, it's sort of middle of the road bullish. Aaron Swenlin and Carl Swenlin earlier this week highlighted the fact that the Rydex ratio is at all-time lows, which we've talked about before. I've inverted the chart here to be more similar to other sentiment readings that we look at, but the value is very, very low, basically indicating, or the chart is very high, indicating a very low reading, which indicates individual investors at least are all in, bulled up in the most offensive parts of the Rydex family as opposed to the defense and cash-oriented parts. That is our quick rundown of sentiment called Getting Sentimental. Our next segment is one we've not done in quite a while. It's called Level Up. One of the things we talked about many moons ago was just reinforcing some of the ways to use stock charts and to upgrade your own use of technical analysis and charting using the stock charts platform. So what I wanted to share with you today are just three ways to compare two different securities. And we had a question on this recently as we were looking at yield spread. So I'll tell you a couple different things. First off, remember that the easiest way to compare two securities, number one, is with a ratio. So anywhere up here at the top where you type a normal ticker, instead of just typing one ticker, you can do the colon, the two little dots, and then type any other ticker. So here I can actually do a ratio of healthcare versus technology and show the ratio of the two of those. And I can run indicators on that ratio. and do whatever indicators or analysis I would normally do on just a price of a stock or ETF. You can do the same thing on a ratio. So it's an easy way to do it. I actually use this all the time. At the bottom of my charts, I often have a relative strength ratio, just a performance ratio of one stock to something else, usually the S&P or the VTI, some sort of broad equity benchmark. That is using an indicator called price dash performance, and you just enter in the one ticker, the colon, the second ticker, and you can get that ratio. So that's a great way to compare two different things. And I will tell you, as an institutional investor, you spent much of your time thinking about relative performance because that is how you got evaluated. That was how you got paid, was your ability to outperform a benchmark. And I found for individual investors, they could use a little more focus on that because it tells you whether or not you're looking at the right chart in the first place. It's a great starting point. You can also type one ticker and then just a little minus sign and the second ticker. This is anytime you're looking at two different interest rates or percentages or something where doing a ratio doesn't make as much sense. You just want the one value minus the other. So when I was showing the yield spread yesterday, I did $ UST10Y minus $UST2Y. Now you can do that for any two tickers of any sort. So if you want to, for any reason, do the difference between two things, you can easily do it. And again, run all the indicators and analysis that you would do on price of one instrument. You can do it on the pair. So this is I use this most oftenly for yield spreads or differences in two interest rates. So you do the one ticker minus the second ticker, and that's the way to do it. The last thing I would tell you in terms of using the platform as a power user, leveling up your ability to analyze and compare securities, is do what's called the gallery view. This is a gallery view, and if you type it on one stock, you actually get what's called the gallery view: an intraday chart, a daily chart, a weekly chart, and a point and figure chart. Now, if you do this for the first time, you're going to be using our standard default charts, but up at the top, there's a little gray line and a blue button that'll tell you how you can actually customize these, which I've done for the charts that I actually want to do. Now, if you add one ticker and then a second ticker, so if I did Disney and Alphabet, for example, I'm now comparing those two charts and I can look at them on a side to side basis. And again, if you're trying to differentiate between two stocks or just trying to decide whether you want to buy Home Depot or Lowe's, Coke or Pepsi, this is the way to do it. Gallery view, the first ticker, comma, the second ticker. That's our segment, Level Up, upgrading your use of technical analysis on the StockCharts platform. We need to wrap the show. Go to the 3 in 3, three charts in 3 minutes. Here we go. Chart number one is the name exposure index, the Rydex bull bear ratio. We looked at this in our segment on sentiment. And as you can see, the the name exposure index, sort of mildly bullish. I think what was interesting is I mentioned the article, which you should check out, from Aaron Swedlin earlier this week, focusing on the Rydex ratio being at extreme lows. And she's absolutely right. This indicates that, or implies that individual investors using those Rydex funds are basically all in. This is the most bullishly positioned that they've been in the history of the data series, going back years and years and years. Worth noting, we're at sort of a euphoric extreme there. Chart number two is a chart highlighting a stock breaking down. Biotech's really feeling some of the pain today. We didn't get a chance to look at too many of those with Biogen, AMGN, others starting to struggle. AbbVie as well, sort of breaking and making new swing lows today. Amgen was maybe the best example of this, of a chart really in distribution mode, and the price breaking down through moving averages, continuing lower, the momentum being relatively bearishly positioned, but also the relative strength just being so negative over a year now, year and a half, really since the March market low. You've not been paid to own Amgen over the market. And so it's a choppy chart in a world where most charts are going up and to the right. You could make the argument this is getting to the lower end of this range. Is this a time to potentially buy on weakness? Some make a practice of doing that. I certainly do not. I would much rather be interested in seeing some signs of accumulation, which we're not seeing yet in biotechs, particularly Amgen. Finally, there are plenty of stocks that are rotating to the upside. We talked about Disney a little earlier in our market recap, but a chart rotating up and rotating from more of a distribution phase to an accumulation phase. First Solar might be another good example of that as well. This is a stock that was down in the first quarter and really through May. This is when it hit the swing low, tested the low from March again, just below $70 a share. From there, we've gone back to the upper end of the range. And then in the last month or so, rotated above that and now following through to the upside. So yesterday gapped higher and pulled back, but today sort of completing that move to the upside. Could be a further upside move up to previous highs around 110. But I like charts like this that are showing new price highs, testing new relative highs. Those are compelling charts to pay attention to. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Todd Sohn, Strategas Securities, joining us from the New York area. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.